All right. Hello, everybody. This is our last panel for the day. Come on in, take a seat. So the last panel of the day is going to be talking about tokenized US Treasuries, digital gilts, and beyond, the next generation financial infrastructure. So I'm happy to welcome Kate Lowe, who is Deputy CVO and Head of Data and ESG at Euroclear. The panel will be moderated by Amy Denier, who is Global Head of Capital Markets at Kaiko. We are welcoming Horatio Baccarat, who is Head of Digital Innovation at Broadridge, as well as Justin Peterson, CTO at Tradeweb. Thank you very much for being here. And thank you for closing that day with, honestly, tokenization of US Treasuries and Gilts is a very critical part of, moving the industry on chain. And so thank you for being here, and I look forward to listening to the conversation.
Thank you very much. Hi, everybody. Thanks for being here. It's just us, and then afterwards we can go and have a drink upstairs. And thank you very much for being on the panel here today. So the tokenization of US Treasuries and digital gilts, and this is a very important topic because we're seeing more and more tokenization, particularly of these bond products. I wanted to start by talking about velocity and capital efficiency. I wanted to ask you whether you thought the true value of tokenization of these products was more on the issuance side, or do you think it's more in the secondary markets? Open question.
Open. Well, for me, I guess you've got the primary market and the secondary market, and I always like to think in analogies because it helps my adult brain really think through how markets work. And the way I think about it is the primary market is very much like the premiere of a movie, where you're having a very static, timed event where you're, the price is agreed, you've only got limited attendance, and there's only a few participants who are attending the premiere. But where the real money's at is in the streaming service. So really, what I think about is the secondary market is the winner in terms of blockchain, because it's able to mobilize, redistribute assets in a way that the primary market is just not set up to do. So whilst issuance is important, very important, and it's very important to getting those assets on chain, I think the real return is going to come from the secondary market, where you can take those assets, move them more quickly. You have a lot more transparency, and everyone is looking at the same record of a particular asset. And all of those things are going to yield a significant return. So I'm personally looking forward to when we can move from just issuing, but well into the secondary market, where we can really test what blockchain can do for us in the wholesale markets.
Yeah, I agree. And by the way, I love your metaphor on movies in Cannes, right?
Yes,
it doesn't get any better than that. So I agree. So if you think about the ultimate goal and objective of tokenization is to increase the velocity compared to the traditional asset, right? So with that in mind, once you tokenize it, and the primary issuance, you might get some benefits, some operational benefits related to asset servicing, maybe corporate actions, maybe cheaper way of doing it. But as I said, tokenization by itself is just a one-hand clapping. You need to have platforms like Tradeweb, like Broadridge DLR, that actually get velocity and actually get that token moving. Once you get that token moving, then that's when you start getting beyond operational benefits into capital savings. You get into reduced cost of funding, really, which are orders of magnitude in terms of benefits compared to just the operational benefits.
Yeah, and I definitely look at it from the point of view of settlement. If you look at electronic trading over the past 30 years, I've worked at Tradeweb for 26 years, so I've seen a lot of that. there have been dramatic changes and significant increase in efficiency in electronic trading. So the people at end of month on a day like today can trade a massive portfolio in a very short period of time. You could do a portfolio trade that has over 5,000, close to 10,000 positions. You can hedge, effectively we hedge the entire IG market that's traded on our platform every day. So all these things have been done over the past, let's say, 30 years. And this is, I'm going to be a little humble about this, which is something I rarely do, but I don't know that settlement has progressed as much. And so if somebody who's worked in settlement and progressed it a lot, I apologize.
Fair.
Please correct me if I'm wrong, but to me, it's still the case. And so the problem really there is, so we talk about at Tradeweb that we're offering liquidity to our clients, and we certainly do from a trading perspective. But honestly, it's not really liquidity until you get access to your funds. And the fact that access to your funds or your ability to finance through a repo is very restricted, in my view, there's no really good reason for that. It really should be choice. I should be able to settle when I settle, trade when I want to trade, and there should really be no operational constraints around that. And thus, I think the move to 24/7 trading, 24/7 settlement is really the key. And even though digital issuance is great, to me, that's a much more dramatic improvement to the way the financial system works. Are you in settlement?
I am in settlement. And I would just note that 24/7 trading is great, but
Right.
if you don't have 24/7 settlement
I agree.
to support it, then you are basically running massive risk overnight,
Yep.
which I don't think any of us want. So I think we need to work together to really create this new ecosystem that's going to support this capability going forward.
Yeah, but I think over the past year, we've demonstrated, you guys have demonstrated, we've demonstrated that with DLT, you can settle when you want. You can settle roughly instantaneously. You can have a repo whose term is 5 minutes, so you can get in and get out very quickly. You can suggest that maybe we'll settle in 3 hours from now, whatever it might be. For if you want to net your trades, maybe you'll want to settle at end of day. But it's really about choice, in my view. Whereas right now, a lot of choices are off the table because of really the way the operations function. And so I think it's really about extending choice to investors so that they can basically complete the trades, complete the transactions that they wish to, whenever they wish to.
Okay, so the value is really end-to-end, so issuance, trading, and settlement, and we're getting there. In your opinion, why are tokenized, government bonds or treasuries, so popular? So why do governments or central banks push this as a good product to tokenize?
Should I go? So I guess in the UK, we've recently seen that the UK government has launched their digital gilts. It was a procurement that went into the UK digital securities sandbox. And I think, I would like to believe that the government was really focused on improving infrastructure and trying to create value for participants in the market. But I think really fundamentally it comes back to control. And for me, what we've seen with Trump coming in for a second term, a lot of the regulation around crypto being crypto assets and blockchain suddenly taking a big leap forward. What's happened is that the UK and Europe have suddenly woken up and said, actually, this blockchain thing isn't going away. We need to control it. We need to figure out how we impose ourselves in the system. And I think that's why digital gilts and tokenized US Treasuries are so important, is because they're the lifeblood of collateral. You literally cannot do anything. Well, if you're an asset manager in Europe, you know, there's regulatory obligations to holding these types of instruments. And so you see that this is really a sovereign play to impose control again. And also to galvanize the market, because I think, you know, what we saw in the UK is that the UK digital securities sandbox opened up, and you had 8 fintechs sign up, and that was it. And I think what the UK government realized is, okay, we're going to have a hook to bring people in, to make people care. And how do we do this? We do it by taking sovereign debt and putting it on chain, so that now you're forcing traditional participants like banks and CSDs to sign up to the sandbox. And guess what? It worked. You had LSEG, Euroclear, JP Morgan, HSBC, everyone signing up to the UK digital security sandbox, because there's a recognition that it's a much bigger market. And I think the government was really about catalyzing and getting the market moving. And the way to do that is strike them at the heart and focus on sovereign debt.
I have a different view.
Okay.
So I think government involvement in tokenizing treasuries, gilts, and any G7 or HQLA type of asset, it is going back to is to increase velocity and availability of those assets. So if you think about the last liquidity crisis, right, in the repo market in the US in 2020, the last one in the gilt crisis of 2022, the main reason for those liquidity crunches were about the inability for market participants to actually find, place, and put collateral and post margin fast enough. So if you think about the ultimate goal, going back to my previous statement, that the goal of tokenization is to increase velocity, it is, obviously you have tokenization by private participants like us, right, Tradeweb and others, but the governments are actually looking at tokenization to actually reduce the risk of the market, just to make sure that collateral that is available to post margin and is critical for liquidity and market participants, they can actually find it, they have it available, and they can move it as fast as they possibly can and should. So that is from a liquidity standpoint. Then you think about, and we're talking about the ability to finance yourself by the minute, by 30 minutes, half an hour, right? That has the impact of reducing significantly your capital buffers. Yeah. So if you can reduce your capital buffers, then you have a much more efficient market infrastructure. But at the same time, you can reduce the capital available or needed in the market, but at the same time, improve the liquidity in potential crisis. So I think that's why governments are leaning into this tokenization, particularly around high-quality liquid assets.
Yeah, I agree with you on that. And definitely it's the case that it's about reducing the risk in the capital markets, which is obviously a significant concern to any government. I will say, however, that I do get a little nervous that when they digitally issue an asset, there may be a tendency to be a little prescriptive about how that asset is traded, settled, whatever it might be. And I can tell you, at least from the efforts I saw that we had to make to satisfy the Dodd-Frank legislation, is that a lot of, it was great for the company, and there are a lot of wise things that were articulated in the legislation and the rules of the CFTC published in the US, and obviously MiFID did and Japan did as well. But there is a tendency to be a little overly prescriptive, and for folks who may or may not have an in-depth knowledge of markets, when they get overly prescriptive, it does end up being a little inefficient. So I worry a little bit about that, but there doesn't seem to be any concern about that happening in the U.S. anytime soon. So we'll see. So maybe in 3 years, but yeah.
Thank you very much. Okay, so there is this risk of being prescriptive, but at the same time, I hear that there is a push for reduced risk and increased adoption. So now if we move on to the question of interoperability and systemic risk, we see many private and permissioned ledgers that are, being created, do you feel like we're inadvertently creating liquidity silos that will be difficult to connect if there's a period of market volatility, or do you think this is what we need and interoperability will help the end investor?
You will have multiple collateral locations, right? That is going to be a fact, right? That there is, and that is a nature of, similar to today, that's a nature of natural competition. If you see an opportunity, you're going to find multiple networks, multiple blockchains, multiple platforms, right? So I don't think you're going to get away with, one to rule them all. There's going to be, ones that are specialized on particular spaces. You probably, Canton on the institutional space, kind of clear leader. But you will have multiple locations where collateral reside or are tokenized or are issued, which is not dissimilar to some of the kind of the silos created today in multiple CSDs, CCPs, and custodians. The big difference is that it is much easier, given this technology that we all live in, to interoperate and actually move collateral between those networks, as opposed to what it is today. So those I would call it silos, but those pockets of collateral are going to exist, but moving or minting and burning tokens from one chain to another one, or actually migrating from one wallet to another one, or in the same wallet, multiple chains, right? That allows for that interoperability between networks that even though those pockets will exist, it will be much easier to interoperate and move assets around than what it is today.
I'm not sure I agree. I feel, and I see this a lot when I'm going to the conferences and listening to various speakers, but it's eerily, I originally grew up in the FX market and spent about 17 years there, and the FX market is, it's a very fast-moving market, and there's a high-frequency trading, and you have lots and lots of messaging protocols and connected via APIs. And what I'm seeing in the blockchain world that's coming to traditional finance is a very similar concept where you have, you still have intermediaries. You have, you've got two blockchains, so now you need a bridge that's going to connect those blockchains. And then if you've got multiple blockchains, you need more bridges. And for me, that's points of failure. So the more players you have in the mix, the more intermediaries you have in the mix, the more opportunity there is that something's going to go wrong. It's like when you trade an FX and you trade on the platform, then the platform sends a message down to the banks and says this trade is done. The banks then do another confirmation, and that's via SWIFT. And then you send that message into your post-trade infrastructure, your back office, and then into your settlement infrastructure. And you can see that at every link in that chain, there's opportunity for things to go wrong. So for me, I think we need to, as an industry, and particularly for wholesale capital markets, we need to be thinking about how can we collaborate more and not just think about interoperability, but think about potentially working on the same network so that we can, we're not exposing ourselves to that risk, because the more intermediaries you have, the more risk you're going to have in that chain.
Yeah, I'm not as particularly concerned about that as you are. I think with interoperability solutions, you will not have the problem of dropping a message on the floor. I think that'll be covered by the technology. But I got a different point, which is I actually think when you look at the networks, they really represent communities and communities of people that want to interact. And it's not just interact in terms of trading, but they're interacting over a set of services. And they have a certain set of principles which form the foundations of the chain and what the chain actually does for them. So, for instance, on the Canton network, we prize, and I assume everybody else who's on that network prizes privacy. And so if you look at the way what we do for a living is very much about making sure that our clients' data is not exposed to other clients or to the outside world. So for us, we're looking at privacy first. Whereas on other networks, I would assume that requirement is less paramount. So I do think if you look at it, it seems, because you don't actually hear about a lot of interoperability. It's not like people are pursuing interoperability solutions in a mad way. There are solutions out there, there's technology out there, but it's not like, we've done our work on Canton. Now, so when somebody says, are you chain agnostic? I say, yeah, sure, of course I am, right? So as long as the chain can satisfy the privacy requirements that we have, I'm all good. But we would be happy to take an asset from another chain and actually do the settlement on Canton is usually what I say. 0 people have taken me up on it. So I'm not sure that for there to be interoperability, that means the communities want to come together, and it's not abundantly clear to me that these communities want to come together. They kind of have different sets of principles, different views, different values, whatever you want to call it. So I'm not as worried, shall we say.
Fair. I obviously spent a huge chunk of my career in the post-trade space, and I think I'm scarred by that, and really, really aware of, technology does fail, and it fails all the time, even blockchain technology, and we've seen it fail. So the more systems you have in the mix talking to each other, the more likelihood that a particular event could occur. But I think we're all driven by our own experience and what we've experienced in our lives. And for me, it's been spending time in prime brokerage and post-trade that has really given me visibility into what can really go wrong in the back end.
And that is the role of intermediaries in a sense, right? So the intermediaries play a significant role, right, in bridging a lot of these systems, a lot of the front to back, and then horizontally across exchanges, across CSDs, right? So I would say intermediaries will always exist, right? And as long as you accomplish the ultimate goal of having the velocity in the asset that you want, then how many intermediaries do you have, whether you have multiple chains and you have one intermediary per chain, as long as you achieve your objective, having intermediaries is not necessarily a bad thing, because you can actually depend on them because they become utilities, they become market infrastructure. So this intermediaries is seen as a bad word. Really, it is just they're performing a service with the objective of, in this case, personally, I think about collapse on mobility and velocity, right? I don't see that as a bad thing necessarily.
I think in my experience, though, again, the more intermediaries you have, everyone needs to get paid. And everyone is going to, so every intermediary you have in that chain adds cost. And I think for me, the whole promise of blockchain technology is that we make it simpler, that we reduce cost, we create efficiency, we're able to change the old way of doing things, which was, multiple different intermediaries where you're having to pay every link in the chain. You're paying SWIFT, you're paying CLS, you're paying Triana, you're just constantly paying to every intermediary because they're fulfilling a function. But those costs add up. And I would like to believe that this technology is hopefully going to give us an opportunity to reduce that down, add value, create networks where your risk is lowered and your cost is lowered. And for me, that's an important key element for our clients.
Thanks. I've heard that a lot actually about the fact that this new technology is going to reduce the number of intermediaries. I find your point of view very interesting to say that in fact the intermediaries are going to change. Maybe we can just dig a little bit deeper. Do you feel like traditional players might take on some new roles maybe in this world where either they take on new responsibilities, or and so in the end, is there going to be a reduced cost for the investor?
But
I mean, so I definitely think it creates an opportunity for increased competition. So without naming any specific vendors that I've worked with for many years now, many of them are not great at their jobs, but they're in a nice little niche spot where there's not much we can do about it. We just kind of have to suffer through it, right? So a lot of that has to do with, there's obviously inertia, but there's also the way the infrastructure works. It does create a lot of friction in terms of when one wants to make a change. So trying to move from using one vendor to another is really difficult for our clients and even for ourselves. So to me, the fact that you're on a network, and I agree, not too many networks, would really allows for increased competition. And so it's really about who's really proud of their work, who's doing great work, and hopefully they'll succeed, right? And so I think that will reduce costs significantly. But I think the other thing that's going to occur, if you look at the way the ecosystem is set up now, at least in the electronic trading space, you have bundles of services that people are offering. And sometimes they're great at some of the services, not great at the others. And I do think it creates an opportunity for a reduction in maybe the size of bundles, such that somebody could come out and offer a really great service that's currently being offered by somebody who's bundling it up. But because you've got the network which is allowing services to work together, that could change. And you could see services move from one institution to a potentially new institution or an old institution. So I do think things could get reformed, and I think it'd be beneficial to the market. I think it will reduce costs, like you say, and it'll be great because then you won't get a phone call at 2 a.m. because somebody's system's not working, right? So, I mean, sounds great to me.
I totally agree with that. I think that I was listening to a panel in the other stage, and everybody was talking about clearing for crypto, custody for crypto, netting. And those are much needed intermediaries to actually create that industry at scale, right? There's no enough, as somebody said, there is not enough cash to actually settle atomically, right? To settle automatically. So those intermediaries and those functions, some of them are going to exist because they are key to the scaling up of the industry. And if that is the case, yes, those intermediaries will take a cost within the infrastructure, but the cost is the minimum compared to the massive scaling of any industry or any asset class. So I believe that some of those intermediaries and utilities will exist for the benefit of the industry, and whether those are existing participants, existing players, or new ones. I think it's going to be a combination of both the new entries that are very smart and very quick, and then the incumbents that actually have already started moving in the space and moving their services from traditional into digital. So I think it's going to be a combination of the both, but some of those intermediation activities will still exist: netting, clearing, custody. Those have to, for the scaling of the business.
No, I agree. I think every clearinghouse, every CSD is going to have to evolve because we're very much acting as operator registers as a CSD. I think in the future there's still a place for us, but that place is a different role. We're essentially going to become network orchestrators who set standards, who keep an accurate legal register of who holds what assets, because I think in wholesale markets, you're not going to have the UK, or the Debt Management Office of the UK agree to issue bonds and rely solely on a validator node to distribute those bonds and validate the ownership of those bonds. And so there's going to be a role for all of the traditional players, or some of the traditional players, I should say. But we're going to have to change. We're going to have to evolve and think about our role in a different way and think about what value we can bring to the ecosystem.
Super. Thank you very much. I'm looking at the time. I think we're going to stop here. Thank you so much for being on the panel today. Thank you all for listening in.
Thank you so much. That is the end of our content for today. Thank you to our amazing panelists. Thank you for amazing listeners. And I was supposed to do closing remarks in the theater, and I've decided that I will do them upstairs with a glass in my hand and the sunlight in my face and the ocean in my eyes. So the sea, not the ocean. So I invite all of you to just migrate upstairs for drinks and aperitivo. And thank you again for making these days. Oh, the stairs are open. That's great. So no more bottleneck. Thank you so much.